Welcome back to Vantage. We've been talking a lot about this pivot from growth to value, and I wanted to get someone who I think is inspired by Warren Buffett and value investing, amongst other things. Delighted to get him on the show. It's his first time. Let's go take a look. Delighted to have Andrew Hollingworth, partner of Holland Advisors, which invests through the VT Holland Advisory Fund. Andrew, welcome to the show.
Thank you.
You're new to our audience, so it'd be good if you could just chart a little history of, how you ended up at Holland Advisors, your history, and in particular, talk a little bit about the VT Holland Advisors Equity Fund, what it's trying to achieve.
Sure. How did I end up here? I am 53 years old. I started investing in the stock market when I was 18 years old. And I don't mean that as in I bought a share at university. I mean, I started in a job about 5 miles from here when I was 18 years old in a sort of back office department. And I've been involved in equities ever since. So I've worked my way through various did my analyst exams and joined the British Gas Pension Fund and then worked at Merrill Lynch as an analyst for 10 years or so. And I suppose the seminal moment for me was in about my late 20s, early 30s. I really discovered Warren Buffett and all the stuff that went with him and all the reading that went with him and all the rest of it. Mm-hmm. And so I've suppose I could categorize my career into the bit that before that time and the bit after that time. And the bit after that time, I had a bit of structure. I knew what I wanted to do. I knew how I wanted to do it. And then eventually, about 10 years after I first really researched him, I then set up my own business, which is what Holland Advisors is. And that set me down a path of less turnover, more analysis, more thinking, more buy and hold, more trying to find great companies. So eventually in 2011, I launched my own fund, which is what you described earlier on kindly as the VT Holland Advisors Fund. And then converted that into a UCITS fund in the summer of 2021. So it was a private investors fund for friends and family, and it's now available to all investors, if you like. But yeah, that's the short journey.
Okay, interesting. And I mean, you mentioned Warren Buffett, and I read some of your stuff, and I actually really enjoy it. And
thank you.
The reason I thought it'd be a good time to talk to you is that over this year, you've seen this move of, inflation, higher rates, and a quite volatile market. And as people are starting to focus into next year, the era of free money is over in many ways, and there's a focus on value. And I just wanted to get your take, effectively, of how you see the world going forward, whether you suddenly think value is going to come into vogue, and whether finally you're going to be fashionable.
Fashionable, gosh, I've got a tank top on here. I think the last thing my wife would ever describe me as fashionable. I think the value and the growth thing is a slightly strange way, and I think some people would read me as a value investor, and obviously that's how you've read it, and I obviously do admire many value investors that have gone in the past. Mm-hmm. But the reality is that growth and value are components of each other in terms of would I like to own lots of shares that grow at a really fast rate? Of course I would.
Yeah.
But it's just the price that I pay for that.
Yeah.
And I suppose there was another great investor called Seth Klarman, and he talked about what's called margin of safety. And I think that's the difference, if you like, between those that are seen to have a value discipline, if you want to call it that, and those that just want growth at any price, is that there is quite a lot of investors in the last few years that have really bought into the growth mantra and have effectively said, well, I don't mind paying a really high price for that. And value investors don't do that. And that's something that is it can work out really well, and it did work out really well for some of those investors for a good number of years, but it doesn't always work out well. And I think the likes of the Warren Buffett and the likes of the Charlie Mungers and the likes of the Seth Klarman, are good examples of how, if you take a very long-term view rather than just the last 4 or 5 years with low interest rates, you are right to be just more cautious about the starting price you pay for an investment.
Yeah.
Hopefully it's got lots of growth and you're paying a modest price for it. And then you get that growth at a modest price with low risk. But I think what people like me and a few people like me have done in the last few years is perhaps own a few shares and sort of back a few company managers that are seen to be more value just because they're not going to lose me very much money. And now, actually, if you looked at my portfolio today, I think you'd be quite interested, and maybe we'll come on to it, as to some of the shares that I own now, which might perceive to have been perceived to have been growth shares of yesteryear.
Yeah, okay. So, I mean, we're always interested in the discipline. And I think you articulate, your disciplines reasonably well. So walk me through the process. In particular, I think one of the things that stands out for me is you're very clear about what you're looking for, and you think that that's really important. You characterize certain buckets, so you've got your types of stocks that you look for, and then I guess I'm interested in once you've gone through the discovery that looks interesting, the work you undertake to really get under the skin.
Yeah, I mean, in terms of, I have learned a massive amount from whether it's the Buffetts or the Chalmers and all sorts of different people, and I was studying some Peter Lynch stuff the other day, and I think you just pick a little bit from these people that sort of suits what you're looking for.
Mm-hmm.
So for example, I referenced Seth Klarman earlier on. I've looked at a number of his shares. I don't understand what he sees, so he thinks very differently to me.
Yeah.
Whereas the sort of Peter Lynch sort of way of investing, which was basically trying to buy growth that's going to go on for years and years and years and years and isn't going to fade, but try and pay a decent price for that, which is sort of Buffett's mantra as well. That really sits with me because I like these sort of predictable growing businesses, but not paying too high a price for them.
Yeah.
And so I sort of typify that as sort of what I call a great a great company run by a great manager, available at a great price.
Yeah.
And then the other sort of tick boxes I've got are what's called operate, generate, and allocate. So are they a great operator in their field? Do they stand out from the crowd as a company? Have they got a good brand? They've got a good market share?
Mm-hmm.
Do they generate good returns on capital?
Yeah.
Which is usually fairly easy to say yes or no to. And then do they allocate that capital well? Either in terms of organic growth or share buybacks or occasional disciplined acquisitions, or do they allocate the capital poorly? And so I'm just trying to look at nearly every company via those lenses, and some of them are, break the mold a little bit, and you have to decide whether or not you want to break the mold for them. And others, fit that criteria quite quickly. And to talk to your point about how you do the work, it's if a company, I suppose one way I describe it is that my favorite type of investment is what also looks like this.
Yeah.
So Schwab is the same as Amazon.
Yeah.
Ryanair is the same as JD Wetherspoon.
Yeah.
Now, that doesn't mean they are going to give you the same performance, but it means that if you discovered one model and you've understood it, the next one comes along and you go, oh, I know this business model.
Yeah.
Now, that doesn't mean you know the management, doesn't mean you know the products, you've got work to do those. But I think I understand the Schwab business model better than a lot of banks analysts that analyse Schwab, just because they've never seen the scale economy share business model before.
Yeah, and I think the advantage you have there is that we, particularly analysts, tend to be quite sectorally focused, whereas you looking across sectors see things that perhaps a guy looking at pubs won't see in an airline, right? So.
Absolutely. So I don't do sectoral models. I don't do sectoral analysis. I don't even do country analysis. Mine's sort of mental models. Yeah. And that's just moving around the world to say, as I referred to, what also looks like this, and have I seen this model before? And when you get into what I call the scale economy shared model, which we could talk about if you like, but it's a really powerful business model, but there tends to only be one stock in a sector that does it.
Yeah.
So as a consequence of which, the analysts haven't got much chance to understand it because they've maybe been let's say a brewing analyst or a pub analyst for 10 years. They've probably only ever seen one scale economy shared business model.
Yeah.
And they don't really know what it looks like.
Yeah. And another way of describing, your model is that you've got businesses with a great moat. So, successful operators are going to be hard to compete against. With a management team who is, capital discipline and effectively looking after shareholder returns. I've been struck by, some of the work it's a Buffett thing as well. Owner managed businesses. People who act who entrepreneurs who are acting in the interests of shareholders. And I was listening to something where you characterized different types of entrepreneurs. The guy who doesn't list it in consensus and is operating to the market, to the guy who's been in the market for 20 years and may not listen to consensus, but is attuned to how to sort of message that into the market. Do you want to give us some examples from your portfolio of the sort of different types of entrepreneurs that you have?
Yeah, I think that's a good way to look at it, actually. I mean, obviously, they don't perfectly fit into buckets,
No.
but let's just try and give you a few. So I don't know. So Simon, I now own Next again. Delighted to own Next again. Bought it recently. Always admired it and owned it for a while, but the shares moved away for a while. So I bought Next again recently. Simon Alston, I think, is probably the best chief executive in the UK. But Simon Alston is very much out of that Warren Buffett mold, in the sense that he runs a good company. He allocates the capital really well. He communicates brilliantly, and everybody loves him.
Mm-hmm.
So it's sort of, the shares are often priced well because of that, but they're not always priced well. So hence my recent sort of opportunism. But he's a good example of someone that is sort of doing everything right, not just running the business, but also communications.
Yeah.
And then you've got people that I think are running businesses with, you could call them the Wizard of Oz's, if you like, where they run businesses with lots of levers in. And they articulate it quite well, but there's so many levers that it's not easy for the investor to understand exactly what they're doing. So Michael O'Leary is a bit like that, and the chief executive that runs Ashton is a bit like that. And they're using negative working capital, they're using a bit of leverage, they're using some organic growth, they're using suppliers negotiations. And those are equally powerful businesses, but perhaps there's just a little bit more complexity that they can't help. I mean, they communicate quite well, but they can't really communicate that message to investors comprehensively, because it involves lots of moving parts, if you like. And as I said, they don't really fit into buckets, but if I had to pick a third category, it's actually my favourite category. It would be the just out and out maverick.
Yeah.
And that's Mike Ashley, and that is a chap called Sardar Biglari. And if anyone looks at my fund, the biggest holding we've got is a company called Biglari Holdings. And if you think Mike Ashley was a hated individual 2 or 3 years ago when he was running Sports Direct, you need to meet Sardar Biglari, because he is absolutely despised by the US investment community. But he's a very interesting man who is running a very successful business very capably, but he spends zero time communicating with investors. He's not interested in Wall Street at all. In fact, he despises Wall Street. And I think that's when you can get some real disparity of value and price and growth potential comes from those types of companies. So I don't intentionally seek out these sort of troublemakers, but if they're what I classify as money makers and great compounders of returns over time, and they're priced effectively for bankruptcy, then that's a really interesting combination.
Okay, well, let's develop that a little bit. So I was always struck. I think, analysts sort of visualizing and playing a sort of mental picture is quite a useful exercise. And one of the things that always struck with me was, you projecting to me that in the middle of the pandemic, that if I had dinner with Michael O'Leary today, this is what I would be asking him. And, Michael O'Leary famously bought his planes at a knockdown price, and there was an opportunity to do it again. And there was the idea that capacity would be taken out, and that's good for the industry, and all of that. So run me, if you think about, some of the investee companies that you have, walk me through that sort of mental process of, look, if you're sitting in front of the CEO, what are the types of things that you would be sort of asking of them?
Yeah, interesting you mentioned Michael O'Leary, because I think maybe we had that conversation in the summer of 2020.
Yeah.
And in the summer of 2021, I then had 2 opportunities to have effectively a one-on-one with Michael O'Leary.
Yeah.
One was a group meeting of 3 people, and the other 2 didn't want to ask any questions, so that was fine by me, because he's quite a terrifying individual. So you have to be, a lot of these people are quite terrifying individuals. So you have to have done your homework, be on your game, and be direct, because that's what they are. And if they sense that you're a bit lily-livered and you haven't really done research of the company, or you ask a question that shows that your lack of understanding of the business model, then they're ruthless, because they're not interested in spending any time with you.
Yeah.
So I had a couple of meetings with him in that summer, and yeah, I mean, how did I go about the meeting with him? In his case, and as is the case with many chief executives, he's a great salesman. So if you let him sell to you, he'll just sell to you.
Yeah.
He'll just talk at the camera for 45 minutes and off he goes. And you walk out thinking, well, I sort of knew all that because I've read the report and accounts and I've watched you present before. So you have to be very pointed with people like him and say, I just want to talk about pricing. I just want to talk about competitive positioning and what the market share is going to look like of you and Wizz and EasyJet and everybody else in a year's time and in 2 years' time, and what the pricing looks like and so on. And I got some real insights from those meetings, which were very consistent with what I had believed before, which is that they were not just a survivor, but the balance sheet that had the lowest costs. And they were a company that wasn't, up to now, has been very aggressive in their fares, but are not against fares rising just a little.
Mm-hmm.
And just a little in airfare pricing, if you are the lowest cost producer, is a huge effect on profitability.
Yeah.
And that is something that I think is now beginning to be discussed. It's nothing like reflected in the share price. So I think, that's a very interesting sort of particular stock situation. In terms of the wider, how do you use time with chief executives? It hugely varies. And with someone like him, I am quite pointed. Similarly with Fraser's, I'm quite pointed because you want to find out certain things and they will only give you a certain amount of time. But sometimes it just takes a bit of time to be in front of people for some of the sort of anecdotes to come and some of the sort of stuff that you hadn't really realised takes place behind the scenes. So in the perfect world, you would have endless time with these people. In reality, you don't get endless time. You get some time, and you have to work out, depending on the individual and the regularity with which you see them, how you want to use that time. So it does vary a little bit from manager to manager.
No, that's great. And I'm going to use that as training for my analysts. All right, let's move into learning a little bit more of what's in your portfolio. And I want to get sort of different flavors of things. So run me through the elevator pitch of, firstly, something that you've held a long time in the portfolio, a favorite.
Well, that probably is either Ryanair or Fraser's, actually, which I've both held for a long time. With Ryanair, we've sort of just gone through that in the sense that it is a survivor. It's got the market share gains. It's got the lowest unit cost, and it's going to be the beneficiary when pricing rises. Fraser's is the other one that's been in the portfolio a long time, and Fraser's is just a classic situation of a maverick entrepreneur who went through a very, very expensive, heavy investment phase, repositioned the company, Sports Direct, from super low discount to less discounting or even premiumization, which is what they're doing with Nike and Adidas brands, and what they're doing in flannels and so on. And what was really fascinating to me throughout that period of investment is it was always logical to me that the margins of Sports Direct, when they come out the other side, would be higher than they would have been in a discount environment.
Yeah.
Because your gross margins are high, you're not discounting. And really importantly, no one else is discounting against you because there was no competitor left to discount it. And that put me at odds with almost every other stock market analyst, because every other stock market analyst was just forecasting, well, the margins used to be 8, now they're 2, they're going to keep being 2 because there's trouble.
Yeah.
And I didn't know how long the trouble was going to go on for, but it did seem logical to me that one day the margins would be 8, 9, even more. And I never dreamed that flannels would be as successful as it's being. But yeah, I think you've now got a business that is going to surprise people by how much money it makes in very short order. And the last thing to say about Fraser's is the disconnect between where the share price has been in the last few years, even having recovered, and where the management incentive schemes are struck at £12 and £15. It's not lost on me, but it does seem to be lost on a lot of other analysts who I think need to be finding a way to close that gap and saying to themselves, well, why does the board think that £15 is the right earnout for a chief executive they want to keep, when the share price last week was at, I don't know, £6.50 or something.
Yeah, no, I was going to ask you about that. It's good you brought that up. Okay, a different type, something new that's come into the portfolio.
Something new. Well, new I think is probably a little bit of tech and a bit of growth, because it's being offered to me at a sensible price. So I bought at some Amazon this spring. Probably, I don't know, late spring I started to buy Amazon. It's only a few percent of the portfolio today.
Mm-hmm.
The way the share price is going, it might become a little bit more because it's being offered at a better and better price all the time. It's a hard company to value, but I think it is. I'm a massive, advocate and believer in the scale economy shared model, and it is the best company in the world for the scale economy shared model.
Yeah.
So I think with the sort of mental model approach that I've got, I should want to own Amazon. It's just a question of trying to understand the price I'm paying, which in theory is an infinite multiple because the profits are very low, but the profits are only very low because of the scale of investment they're making. So what is the sort of look-through profitability? So Amazon's gone in recently. I put a bit of Google in very recently as well for a sort of similar view. I don't think I have a different view on the business model to anyone else on Google. But, I think the search engine is incredibly powerful. YouTube's incredibly powerful. And I paid 14 times 18 months out earnings for it. So I don't like buying businesses just on the valuation, and I've sort of got the same view as everybody else, because I tend to feel that's a dangerous lack of edge if you want to look at it in that way.
Yeah.
But to me, it was just a bit of a setup, and the share price was falling hard. So I bought it at price below today's.
Okay. Something that's contributed. So look over the last 12 months, because it's been an interesting 12 months. Something in the portfolio that's really contributed strongly to performance.
This is embarrassing. Okay. So I own shares in a company called RCI Hospitality.
Yeah.
And RCI Hospitality, I have to admit, runs gentlemen's clubs in America.
Okay.
Okay.
Yeah.
I bought the shares mostly at $25 and $26. I bought a few more at $50. They are now $85.
Okay.
I bought them in the pandemic because everything was shut.
Yeah.
They owned the freeholds of the sites. It's not how I choose to spend my time, but it is how some people choose to spend their time. It is a quoted company. It does file its accounts on time. It is in my investable universe. It is also run by an incredibly maverick stroke good owner operator. So it was almost a setup for me of how low the valuation of the shares were against the freehold property, against the earnings power of the business, and against an operator who was allocating capital really well. I will be honest with you, and those that went back and looked at my fact sheets will see that my percentage in this company is falling.
Yeah.
And the reason it's falling now, it's still really cheap, but I went and met them in the spring, and considering what they do for a living, you might have a perception as to what type of people they were. That's pretty much who I met.
Okay.
And that was actually a bit disappointing, because I think I'm not an ESG investor, but I do think you need to be cognizant of what you do and trying to take people on a better journey. And for example, when it be women's health or education or whatever else, they were just nowhere on that. And that really disappointed me.
Yeah.
So, I am now gradually reducing it, but it's been a fantastic performer. And my job isn't to run a sort of vanilla portfolio, it's to run a portfolio that performs for investors. So that share has done really well for us.
No, that's great. And look, I appreciate the honesty. I mean, I think that's a really important trait of someone who
won't go down very well, but there we are.
Yeah, no. And then, something that's actually, I think it's important to look at the other side, because it walks people through how you think about things. Something that's been a drag on performance over the last 12 months, and how you're looking at that.
See, another stock that I'm going to get pillared for, so that's fine. Let's do two of them. Alibaba.
Okay.
So I never follow anybody into a share. That's not how I think about things, even if it's the best investor in the world. But I will admit that I had been interested in sort of the Chinese use of the scale economy shared model. So I could see it being really powerful in Amazon, and then I could see it being really powerful in Alibaba and Pinduoduo and so on. And then Charlie Munger bought quite a big, or put quite a lot of money into Alibaba, and that really piqued my interest. So I started to look at it, and by that stage, the Ant Financial float had been pulled. Jack Ma had sort of fallen out with the Chinese government. So it was being offered to me at what I thought was a really compelling price. Today, it's about half what was that really compelling price. So I haven't bought any more, and I haven't sold it.
Yeah.
And it is difficult once you start to realise that sort of you've made, you're not definitively made a mistake, but the stock market is moving against you aggressively. I suppose my starting point is to sort of slightly do nothing rather than just add, because I think it's easy to sort of throw good money after bad. And then when things settle down, is to try and then look at it analytically and go, look, did I make a mistake? Should I either sell it now, or should I sell it at a point in the future when I think the value is more appropriate reflected, or should I be buying more?
Yeah.
And I haven't done any of those things yet.
Yeah.
But that is what I did, and I think obviously the political environment in China was already quite poor when I bought it, but I think it has spiraled to a lower level of investor sentiment, and that's what's really taken the share price down a long way. So, yeah, I mean, I think it's about between 1.5% and 2% of the portfolio today.
Okay. You've mentioned Charlie Munger and a few others. Always interested in the managers you admire, and in particular any UK managers that you admire.
Well, I think we've covered most of them. I mean, Mike Ashley, I've been a fan of. I am a fan of Tim Martin at Wetherspoons as well, which is a little bit more controversial because the stock price is currently really languishing and hasn't recovered at all. I think what he has built in the previous sort of 20 years up to the pandemic was to be credited, to be admired. But it's a strange share post the pandemic in terms of what's happening. But that doesn't mean I don't admire what he's built.
Yeah.
I do very much admire him. And then we've obviously mentioned Michael O'Leary. So those are probably the main ones. Yeah. But I'm sure there are others who I will be cross that I've forgotten after this.
No, well, Simon Wilson, you mentioned it. To me, he's one of the sort of standout. See, I think that the way Next handled the pandemic with its communication to the community in terms of, look, we don't know what is ahead of us, etc. But the sensitivity analysis, the staged response effectively in terms of, these are the ways we would deal with it, I thought was a brilliant education for every other management team out there.
You're right to highlight that, actually, because one of the reasons why I've had opportunities to buy Next occasionally is because Wolfson is so honest.
Yeah.
And actually the stock market doesn't really know what to do with that, because most management teams will sort of puff up the positives, and we got a bit of favouring wind from, I don't know, the strength of the US dollar or something, but we'll tell you that's organic growth.
Yeah.
And they'll play down all the negatives. So they are used to this sort of rose-tinted view of the future of the company, which may or may not turn out, but that's what they get told. And in Wolfson's case, you're quite right. On a number of occasions in the pandemic, but also before, when the store sales were declining quite rapidly, he gave these various scenarios and just said, look, it is quite tough, but we'll do our best, and so on. And the stock market slightly panics in those situations, doesn't really know what to do. And that, if you can see that for what it is, which is just honesty, it's not the fact that we won't try. It's not the fact that we're failing, but he's just being honest. And that's given me the only opportunities to buy it, because the stock market struggles with the fact that he isn't rose tinting it, which is what most chief executives do. So no, I agree. And I think that intellectual honesty, both inwardly and externally, is something I hugely admire, and I think is the way to get better at things, which I think is what he's done.
Yeah.
The other thing I'd say about him is that I think if you go and read the Outsiders book, which I'm sure you've read it many times, and it profiles all the best chief executives in the world, I think he would get into a modern copy of that if it wasn't for the fact that he was in an industry that was in a really tough headwind. So he inherited a store base of shop space, at the moment in time that the internet effectively took over and, challenged the retail sector. Now, the fact that he's navigated his way through that and ended up with a business that's now, whatever it is, 75% or 80% online, is to be hugely admired. And I think the future of Next could be much more interesting than the last 10 years.
Yeah.
But had he been in an industry that had a tailwind rather than a headwind, I think he might be seen to be globally a much, much more sort of preeminent chief executive.
Yeah. Okay. And the final question, I think the main thing we try and get across in these interviews is we're all human, right? And I think managers have to manage themselves. I particularly found this interesting through that sort of period of the UK economy, which went through the mini budget and the chaos that sort of followed, and just how taxing it was, where every day was another gyration. What do you do to unwind?
Holidays help.
Yeah.
And it's interesting, actually, I think this summer, because I found, having had a succession of mini crises, I think you underestimate how much emotional energy they can take out of you. And I really enjoy those crises, because that's sort of where we earn our money, really, in terms of looking after clients' money and stuff. But you then probably need a period of calm afterwards. And we haven't really had that period of calm for quite a long time now as an investment community. So bizarrely, I think this spring, I thought I got lots of consumer recovery stocks. I was ready for the recovery, or sorry, this January rather. So I was ready for what I thought was going to happen in my own managed companies. And then obviously with all the cost of living crisis, which is exactly the opposite of what I thought might have happened in terms of the consumer wallet. So sort of pulling my hair out. And then I had a couple of weeks off in the summer or something. And then I came back and I suddenly thought, well, I had a slightly different mindset. I was like, well, this is what you want.
Yeah.
You've had expensive stock markets for the best part of the whole time you run your fund. What do you want? You want Ashtead on a P of 9. You want Next on a P of 9. It's fantastic.
Yeah.
And now, actually, that's exactly my mindset now, is that this is a wonderful opportunity to deploy capital in the stock market and buy shares that you're not going to have to sell for many years to come, which has not been the situation we've been in for a very long time. So I think you do need those holidays and those bits of downtime and those evening games of golf in the summer, which is what I do if ever you're looking for me on a summer's evening.
Yeah.
But yeah, you need a bit of that just to sort of reset your brain, because our job's about making decisions, and you don't make good decisions if you're under too much stress.
Yeah.
There's always going to be a bit, but if you're under too much stress, you make bad decisions.
That's great. Thank you very much for coming on the show.
It's been a pleasure. I enjoyed it.
It's been hugely educational in terms of the way you look at the world, and some great anecdotes there. Always get interested in how things develop. So hopefully a good year ahead for you, and we'll look to get you back.
Fine. Look forward to it. Thank you.
Thank you very much.